The Australian property market is heading fast toward an interest rate cliff. The Reserve Bank of Australia indicates that some $350 billion worth of property loans are due to go from ultra-low fixed rates onto very high variable rates during 2023. This could affect some 800,000 loan facilities. And in fact, the situation could actually be worse. The RBA is only considering loans that are due to transition in 2023, but many more will transition in 2024, suggesting that the property carnage could potentially continue a little bit. Westpac has also indicated something similar. Westpac has indicated that some 45% of their loan book had been able to lock in and secure these very low fixed rates during the pandemic. But again, many of these people will transition onto variable rates in 2023 or 2024. This ultimately, of course, begs the question of how might this affect the property and real estate markets, and also if you are one of those people who is facing a potentially higher interest rate, what might you try to do about this to try to cushion the blow? So let's think about how the interest rate cliff will affect the property market. Most economists think that property prices might fall another 5 to 10% during 2023, but there is a lot of variation. And this is in large part because we're not entirely sure how much more the RBA is going to hike rates. Will it be another 50 basis points or another 75 basis points? We don't exactly know. We also don't know for sure what the economic data will be, i.e. what the inflation data, unemployment data, GDP growth data is going to come in as. It's also not entirely clear exactly how banks are going to respond to these increases in interest rates. After all, banks don't really want to have to deal with mass defaults. The worst case scenario for a bank is going to be having to repossess a home and having to do a fire sale. Banks really want to avoid that, and this is why you're seeing Westpac and CBA come out and say that they're going to try to help borrowers who are struggling with the higher interest rates, potentially enabling them to go into interest-only loans, or potentially extending the loan term so that they don't default. So we have a ton of moving parts here, and that latter part, what banks do, could ultimately cushion the blow. After all, if banks stop people from defaulting, then those people aren't going to be doing fire sales, so you might not get this mass deluge of properties coming to the market that people might otherwise have expected from this interest rate cliff. So let's think about how all of these factors play together. So if we're looking at the RBA is likely to increase rates a little bit more. However, people already know this, so to some extent the interest rates and what's going on with them is already priced into the market. People can see the RBA might hike another 50 basis points, for example, and as a result, they're going to factor this in to what they're willing to pay. This ultimately means that when the RBA does hike rates and then ultimately does pause, you're not going to get the major diminution in property prices as when there was an initial shock. Put differently, it's mainly new news that moves prices. And when people already have factored in what the RBA is going to do, already factored this in to what they are prepared to pay, and have already expected the RBA might eventually pause, maybe toward the latter part of 2023, and start cutting, this is going to affect what people are willing to pay, particularly when we're getting toward that cutting stage of the interest rate cycle. So it isn't necessarily as catastrophic as it might initially appear. Furthermore, these high interest rates already have affected what people can pay, i.e., people have already adjusted their ability to pay for these higher interest rates, and the interest rates won't necessarily get that much higher. This basically means that you might get some people needing to sell their property due to the higher interest rates, but the prospective buyers have already adjusted what they're able and willing to pay, and therefore the extent to which you're going to get lower prices, it might be relatively muted. Now granted, some of the existing buyers might be super cashed up, and there's only so many people who have massive deposits who can go out and buy. And once you've exhausted all of those people, maybe we'll run into the people who can afford to pay even less, and therefore we might still get some downside, but the downside might not be as bad as otherwise thought because the property prices have already been impacted by the higher rates, and the rates aren't likely to go that much higher. Then we have what's going on with potential defaults. Now clearly some people are potentially going to need to sell their house. They might be struggling with these higher interest rates, and therefore they might need to just liquidate. And you're going to get some of this coming to the market. Some of these will be fire sales at incredibly low prices, but many of them will be well organized. People might see the writing on the wall and sell well in advance to avoid a financial catastrophe. So it isn't necessarily automatically clear we're going to get fire sales. Banks really don't want to have to take repossession and then sell a house into a really bad market. Banks don't want to do that, in part because they won't get a great price, but also they know that they're going to trigger further declines within the property market, which is going to undermine the rest of their property portfolio. So banks are going to do whatever they can to help borrowers who are struggling. Like I indicated, this might involve an interest-only period, or it might involve extending the loan term, or it might involve some other form of refinancing and other assistance that the bank might do, and as a result, we might get less fire sales than people might otherwise have expected from this interest rate cliff. Now, when you put all of this together, it is true that we're going to have a diminution in demand, but we won't necessarily have the catastrophe that others have predicted. Supply appears to be relatively muted. Many of the buyers who can afford their home loan aren't doing a fire sale. They perhaps paused their sale and are perhaps waiting for an interest rate cut so they can get a higher price. So the actual amount of supply on the market might not be as high as people have been expecting, and this means that even if demand has fallen a little bit, supply has also fallen, meaning that property prices haven't actually nosedived as badly as might have been expected. Nevertheless, this interest rate cliff is not brilliant news, and it clearly is going to be something that should affect what you pay for a house, whether you buy a house, and what you do as an existing owner. The next question is, what should you do if you're one of those people who might be facing a higher interest rate, whose interest rates are likely to increase because you're transitioning from a fixed rate onto a much higher variable rate? Well, in all situations, you're going to want to prepare as far in advance as possible, but there are some concrete things you might want to do. First, speak to your bank as far in advance as possible. Banks generally don't want you to default. Banks don't want to have to repossess a loan and do a fire sale. Banks want you to try to keep repaying them because those repayments are how they ultimately make money. And if they ultimately needed to do a fire sale, that both A, will result in a bad price for them, and also B, could further depress the prices within their property portfolio. So they're going to want to try to avoid that. The bank might try to find a solution with you. This might be, like I indicated, a short interest-only period. Or maybe they'll extend the loan term so that your payment each month goes down. And in any case, try to work out a solution with your bank as far in advance as possible. Second, you might consider refinancing potentially with another bank. Many banks are quite competitive with their interest rates at the moment, at least relatively speaking. There's quite a lot of competition within the mortgage industry. If you are able to refinance, consider it. This is sometimes easier said than done. After all, if your loan-to-value ratio isn't great, a bank might not give you a great interest rate. Or if your income looks perhaps volatile, maybe a little bit uncertain, maybe the bank won't want to take you on. So this won't always be open to all people, but consider refinancing and look around and shop around for interest rates if possible. And even if you can't actually refinance, you might want to communicate to your current bank what the options are. Many banks will respond to competitive threats. Many banks will respond when you tell them, well, if I go to this bank, I'll pay a lower interest rate, and many banks will give you a bit of a discount as a result of this. Communicating with your bank is a great way to avoid the laziness tax. Third, you're going to want to try to rationalize some of your spending if at all possible. Many people have already done this. Many people have already cut their spending to the bone. But if you haven't done that, do so, or at least reduce it, and prepare well in advance. You might currently be perfectly solvent. You might currently be able to manage your low fixed rate. However, will you be able to manage that variable rate when it occurs? In order to prepare for that, try to cut your spending. This can include general expenditure cuts, but also you might consider what's going on with your credit card debt. Consider whether it's worthwhile trying to refinance that into a personal loan or into a zero interest rate period with a different credit card. This therefore could potentially save you a ton of money. Consider doing that because paying 20% interest on a credit card debt is going to be a massive cost for you, particularly since you're paying for that out of after-tax income. Next, you might consider what's going on with the revenue side of the equation. You might consider, is your current job paying you enough? Could you transition to a different job that might pay you more, give you more seniority, or just be a better work environment? This would be particularly the case if your current employer might be facing financial difficulties. After all, if your current employer might be doing layoffs, then moving to another employer that might be more financially strong might actually be a good outcome. This is the case notwithstanding the possibility that the last in is the first out in layoffs. So overall, that's what's going on with interest rates and what might be going on with this massive interest rate cliff that many people are going to be facing. If you have any thoughts about this, any strategies for dealing with this interest rate increase, let me know that in the comments below. And otherwise, thanks a lot for tuning in, and hopefully I see you next time as well.